Malawi's newly introduced 0.05% levy on mobile money and electronic bank transfers, a policy now at the center of a broader debate about fiscal survival versus financial inclusion. On the surface, the levy appears modest. But in low-income, high-frequency transaction environments, even marginal costs, industry stakeholders, led by the Association for Digital Financial Services, warn that the measure risks reversing hard-won gains in financial inclusion, particularly among rural and low-income populations who depend on mobile platforms like Airtel Money and Mpamba as their primary gateway to the formal economy. The core concern is behavioral elasticity. Evidence from Uganda, Ghana, and Tanzania shows immediate declines in usage, as consumers revert to cash to avoid cumulative fees. In Malawi, where mobile money has been instrumental in expanding access to financial services, such a shift would not only disrupt convenience but also weaken transparency, traceability, and broader economic participation. From a policy perspective, this introduces a structural tension. Immediate declines in usage, as consumers revert to cash to avoid cumulative fees. In Malawi, where mobile money has been instrumental in expanding access to financial services, such a shift would not only disrupt convenience but also weaken transparency, traceability, and broader economic participation. From a policy perspective, this introduces a structural tension. The government's objective, widening the revenue base amid fiscal pressures, is legitimate. But the chosen instrument may be distortionary. By taxing the very channels that facilitate formalization, the levy risks shrinking the taxable ecosystem over time. Reduced transaction volumes could offset projected revenues while increasing the cost of cash handling for the Reserve Bank and eroding trust in regulated systems. There are also distributional implications. Transaction-based levies are inherently regressive, disproportionately affecting users who transact in small amounts but at high frequency, market vendors, smallholder farmers, and informal workers. This runs counter to Malawi's national financial inclusion strategy, which targets 95% formal access by 2028 and prioritizes vulnerable groups. Politically, the pushback reflects alternative pathways, broadening the tax base, improving compliance through digital tracking, and strengthening non-tax revenues, without penalizing usage. Ultimately, the effectiveness of this policy will hinge on whether short-term revenue gains outweigh long-term economic costs. If history is any guide, poorly calibrated digital levies risk becoming self-defeating. The challenge for policymakers is not just to tax, but to tax without undermining the very systems that enable growth, inclusion, and resilience. This is the evolving story of Malawi's fiscal balancing act, and its stakes are far from